Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 11th of September. I am Steve Brice, standing in for Daniel Lam, who's competing in the Chess Olympiad in Hungary. So after the presidential debate, focus will return to the US economy and to US inflation data this evening. Our starting point is we believe markets are overpricing the scope for US interest rate cuts this year. Investors seem to have interpreted the employment report last week as being weak enough to justify a 50 basis point move. I don't think this is likely for three reasons. First, on the employment report. While the number of jobs created was weaker than expected, especially taking into account the downward revisions to the previous 2 months of data, other areas of the report countered this to some extent. Wages and the length of the average work week actually ticked marginally higher, which are positive indicators for economic activity going forward. So weak, yes, but worthy of cutting interest rates by 50 basis points without advance warning? Perhaps not. Second reason is a 50 basis point cut could be seen as a panicked response and actually make investors worry about what the Fed is seeing that we are not. Now, if we look at data out last night, this doesn't seem to warrant a panicked response. The Small Business Optimism Index did fall more sharply than expected, given expectations around the economic sales and earnings outlook, which fell significantly. However, consumer credit data, obviously how much people are borrowing, was actually stronger than expected. The final reason is any cut is likely to be leapt on by Donald Trump. He's already inferred that any cut would be seen as politically motivated and trying to support the Democrats' cause. A 50 basis point cut, especially one that's not clearly required, would merely intensify this narrative. The question we move on to then is whether the inflation data this evening could trigger a reevaluation of the Fed's outlook when it comes to interest rates next week and through the rest of the year. Now, in terms of what people are looking for, headline inflation is expected to fall significantly to 2.5% from 2.9% in July. This is what we expect politicians to leap on, right? Because this is obviously what people really care about, and it's showing a move in the right direction and a significant move at that. But for policymakers at the central bank, core inflation, excluding highly volatile food and energy costs, is far more important, and this is expected to remain steady at 3.2% year on year. Now, you can get a more upbeat view of this core inflation numbers if you look at month-on-month data. So analysts are expecting a 0.2% month-on-month increase, and that would leave the 3-month annualized rate at around 2%, which is in line with the Fed's target. And it is this that is likely to give the Fed cloud cover to cut interest rates by 25 basis points. So what does this mean for markets? Well, given market pricing and positioning, markets would probably react more to stronger data than lower inflation. So that means for bonds, the risks in the short term are likely to be for rising bond yields, and that's against the recent trend. And this outlook is reinforced by strongly bullish market positioning in the bond market, which we see today. We've argued that any blip in the 10-year US government bond yield towards 4%, which I must admit seems quite a long way away from today's 3.64%, would offer an opportunity to increase the allocation to high-quality bonds and bonds with a longer maturity profile. For equities, any rise in bond yields due to worse than expected inflation could add downward pressure onto stocks in the near term. As mentioned yesterday, we believe US healthcare and US financial sectors may be more resilient to such an environment and offer short-term counterbalances to our overweights to US technology and communication services sectors. That's it from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and I wish you a fantastic day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.